What's going on, guys? My name is Alex, and today I want to do a recap of everything that happened in October. Am I buying? Am I selling? So on and so forth. It was probably one of the craziest months that we've seen in a while, except for maybe February 2018. So there's a lot of cause for concern, and I think that's totally valid. So today I'm going to do an overview of the charts and I guess like how to position yourself going forward. Okay, so first and foremost, October 2018. Let's go ahead and take a look at a monthly time frame. So in October, from the peak to the high, it was a swing of about maybe 11%. So that's definitely quite a bit. We didn't actually close 11% down. There was quite a bit of rallies towards the end of the month. So all in all, it was about like a 7% loss in the market, which doesn't really seem that bad from a long-term perspective. I mean, it is possible to have bad months every once in a while. Doesn't mean there's going to be a recession just because of that. But let's go ahead and take a look at some of the technicals. I want to start with the weekly time frame actually. So if you take a look at a lot of weekly candlesticks, so this is the S&P 500, it does have the makings of a short-term bounce. Although I do want to give a full disclaimer, I am back to being 100% in cash, just based on the price action that we saw yesterday, which I'm going to talk about. Even if the market heads a little bit higher, I don't think that the risk is all that worth it. And I don't think that the risk reward is there at all. But anyway, so we do have the makings of a short-term bounce, bouncing off of this 2600 level support on the S&P 500. There's a lot of lower wick in this candlestick, so I would not be surprised one bit if we come back and retest this 2800 level, which I have here as this red box. Clearly, this 2800 level is pretty important as it's acted as resistance one times, two times, and a few times here before eventually breaking higher and it became support. But we totally just plummeted right below it. We got rejected off of it here in the middle of October, and now we head lower to retest this green support line and the 100-week moving average. All right, so like I said, from a weekly time frame, it looks like a bounce is in the cards. But if we zoom in a little bit, I think there's a different picture that's being told. So this is the 200-day moving average, which I always mention is a very important level. And it's not just like an imaginary line that like defines a trend or something like that. There are actually real trend following systems that will tend to sell if we cannot close above the 200-day moving average. It's a very real trading algorithm line. It's kind of like a parameter for a trading algorithm, such as volume and other things are as well. So right now we're getting rejected off of the 200-day moving average. And the candlestick that was printed on Friday doesn't look very inspiring either. The same can be said for the NASDAQ, getting rejected off the 200-day moving average. And if we look at some other market leaders like Amazon, we're seeing the exact same thing, getting rejected off the 200-day moving average. Going back to the NASDAQ, let's go ahead and take a look at NQ futures, which aren't trading right now. It's 1 p.m. Pacific Standard Time. So this is what I was watching out for. And the reason why I was fine not being in stocks was it looked like we had some kind of rising wedge pattern. And this is pretty similar to what we saw here in April, I believe, where we also had a rising wedge pattern. Typically, these can be really nasty and they can resolve to the upside for a few more candlesticks before breaking down. And so that's kind of what I saw happening here too. So, you know, from the start of the day, maybe to some people it looked like we were going to close above the 200-day moving average. And we actually did end up resolving to the upside for a little bit. But clearly we broke below it. And it's a very nasty candlestick printed on Friday. A lot of upper wick. And it just, you know, that's why it's good to look at different time frames. Because from a weekly time frame, it would seem relatively bullish, I suppose. But clearly from a daily time frame, it's not so bullish. Let's see if I can actually get this to load. And once again, when we look at Amazon from a weekly time frame, there's a lot of lower wick. It definitely looks like a bull hammer. But when we zoom in, we see that we're getting rejected off the 200-day moving average, and this looks like somewhat of a rising wedge pattern. So that's why it pays to look at multiple time frames. And as far as price targets go for November, so you guys already know that my stance is pretty bearish right now. So putting it all into play. So the biggest question here right now is whether this is the high before making another lower low, or whether we're going to retest the 2800 level before making another lower low. I'm leaning a bit more towards this is it. And the reason why is not only are we getting rejected off the 200-day moving average, but we're also getting rejected off the 0.5 retracement, which would probably be an ideal place for a counter trend rally before making the third wave down. And if we zoom out to a weekly time frame, my price target for the S&P 500 is around 2400, because that's where the 200-week moving average sits. And I'm expecting something very similar here to the bear market in 2015 and 2016. So that's going to be the number that I'm sticking with. Same thing for the NASDAQ. That's 200-week moving average seems like an ideal place to bounce. Although the NASDAQ, I could probably, I wouldn't be surprised if we bounce a little higher. Maybe around like 5,800 or something like that. Just because I do see it a little bit more bullish. And taking a look at some of the larger tech stocks, this entire kind of theory that I got here makes some sense. So we're still quite a ways above the 100-week moving average on Netflix, and the same thing for Amazon. And this is something that I do a lot on my channel. I'll take a look at how high we are above the major moving averages, such as the 100-week for Netflix. So here in the middle of June, we were about 55% above the 100-week moving average, and it looks like we're coming back and retest it. And I don't feel comfortable buying until we get very close to it, like let's say around the $240 level. Every once in a while, the Netflix or a lot of these quick growing tech stocks will get very high above their major moving averages. So here in 2016, we're about 45% above the 100-week moving average, and we came back and we retested it pretty quickly. So I could definitely see something pretty similar happening. Same thing with Amazon. We're quite a ways to go before we retest this 100-week moving average. So that's pretty much the theme in all of my videos. I do think that we can't forget about these major moving averages, and I think every once in a while it's totally natural to come back and retest them. So I'm so excited about the idea of getting Netflix at $240 or getting Amazon at less than $1,500. That's so amazing to me. It's probably like the most cash I've had sitting around just waiting to get in the market. So I'll definitely let you guys know what I do in the weeks going forward. Definitely let me know what you guys are doing. And if you're not subscribed to my channel, I basically give like play-by-play analysis at least once a week, talking about what I think the market's going to do. And I can't really brag, but I do think that I'm pretty decent at timing the market. So that's going to be it for this video. I hope you guys enjoyed it and have a great rest of the month. Good luck trading in November. And yeah, have a great day.